Hi students, I'm Dr. Chalaka. So this is my first video in a series of videos titled Finance Made Easy by Dr. Chalaka. So I'm Dr. Chalaka. I have a PhD in financial macroeconomics from Monash University, Australia, and I teach at a range of private universities in Colombo. Right? And many of you all know me from my classes. And today we are going to do a topic of finance called investment appraisal, right? So let's get started on this. Right? So this area of investment appraisal is related to the purchase of non-current assets. Right? So I hope as accounting students, you know what non-current assets are. So non-current assets are resources that are owned by the business, right, which have a large value usually and are kept in the business for a long period. For example, motor vehicles, machinery. So those are non-current assets, right? Okay, so next, right? Now, a non-current asset can be, for example, a forklift truck that you purchase for your factory. You can buy an entire factory, right, which consists of buildings, land, machinery, and a whole bunch of things, right? Also can be something like the construction of a hotel or a bridge, right? So all of these are called capital projects. These projects have four common features, right? So you can see here, right? Four common features. The first one is, right, the expense has to be paid immediately. So these projects require an immediate amount of money to be spent, right, to start building this project or buying the machine or building a bridge. It requires a large amount of money to start the project immediately, and it will last many years into the future, right? So this project, just like any other non-current asset, is expected to last many years into the future, and the income will be received in the future. Right? Year by year, we will receive income from this asset. Right? So the future is risky and the income is uncertain. So it makes the selection of these projects tricky, and it involves a large sum of money. Right? So because of these four features, right, the company which is going to start on this project has to select this project very carefully. Otherwise, it's going to end up losing a lot of money. Right? Okay. Next. Now, because these projects have to be selected very carefully, we use a process called investment appraisal to select these projects, right? So investment appraisal is a common topic which is taught in finance. And there are four common methods. Right? The first method is called the accounting rate of return method. Right? For short, we call it the ARR method. And the second method is the payback period method. And the third one is called the net present value method or NPV method. And the fourth one is the IRR method, internal rate of return. There are other methods also, but these are the four most commonly used methods, right? And which I'm going to be teaching in this series of short videos. So the first method that we are going to learn today is the accounting rate of return method, right? Okay. Now this method is easy to learn, and I have given a set of steps for you to follow, right? So very easily you can follow this set of steps to do an ARR question, and we are going to be doing an example question after this. Okay, so there are 5 steps, right? So you should take a screenshot or photo of this, right, or write it down, right, so that you can follow these steps, right? Okay, now the first step is, right, calculate the depreciation. Now, depreciation is an expense which is related to the usage of non-current assets. It's not a cash expense, right? It's an expense that comes out of the accounting process. So when we prepare accounts monthly or yearly, we include a value for depreciation as an expense. It relates to the usage. It shows the usage of the non-current asset, how much we have spent on the non-current asset, right? So it's not a cash expense that we pay, right? It's an implied cost, right? Implied means it's not really something that we pay cash for, but we include it in accounting. So the accounting rate of return method includes depreciation, and that's the first step. So calculate the depreciation, and we use the straight line formula, right? The most simple formula to calculate depreciation. So depreciation, write down this formula, equals cost minus residual value divided by the useful life. Right? Now you'll wonder what the residual value is. Now the residual value means this, right? So when you have an asset and you have been using it for many years and it's getting old and you can't use it anymore, right? You have repaired it many times and it comes to a stage where you can't really use it at all, right? So it's at the end of its life, it's gone, used up. There's nothing you can do about it. You can't repair it, you can't use it again. So what you're going to do is you're going to sell it for the metal value it contains, right? In Sinhala we call it the Botal Patrakara, right? So we sell it for the metal value. Whoever wants to take it to use the metal value, metal that it contains, we sell it. And that's called the residual value. It's also called the scrap value, right? Scrap value or residual value. Okay. So you divide it by the useful life. So all of these three things are given in the question, right? So you just put it into the formula, find the depreciation. Now, once you do that, the second step is, right, we have to create a format. Okay, so I have created a very simple format for you to follow. So you have the year, right? Year gross profit. That is the initial profit from operating this asset, and that's given in the question. And the question also may give you some expenses, right? Sometimes expenses are given in a question, sometimes not. So you deduct the expenses. Okay, the expenses are generally deducted, and we put them within a bracket to show that it's an outflow of money, right? It's an expense. Then we deduct the depreciation also, right? Here, right? Within a bracket, and then we get the net profit, right? So gross profit minus expenses minus depreciation is your net profit, right? And that is what we are going to use for our ARR calculation. So create this simple format, right, in your notebook, and then you can fill in the values from the question, right? Depreciation is what we just calculated here, right? So this value goes here as depreciation, right? Now I have given the process here also. I've written it down here. From the given profit, deduct expenses and depreciation and arrive at the net profit, right? So easy, right? It's very easy. Okay, then add the net profit for all the years, right? So this total net profit year by year, we have to add and get a total, okay? So that is called the total profit. Then you divide that by the number of years, right? The number of years is the useful life of the asset, right? And also the question will give you the number of years. The question will say, these are the profits each year for so many years, and that's the number of years you take, okay? So then you divide the total profit by the number of years, and that answer is called the annual average profit, okay? Then once you get that, you use the ARR formula, right? So I have mentioned the formula here, right? ARR is equal to the average annual profit. That's what we just got here, right? Divided by the project cost. The project cost is the initial cost of the project, which you used for depreciation, right? So that's it. So you divide the annual average profit by the project cost and multiply by 100. And you show the answer as a percentage. Usually we round it to 2 decimal places and we have to put the percentage sign. Okay, so that's it. Very simple. Now we are going to do a practice question. Okay. All right. So this is a question from one of my tutorials, and students who attend my classes are familiar with these tutorials, right? So those who are not familiar, don't worry about it. It's just a question, right? And the question is right here in front of you. So it's from my tutorial 1, right? So a company has proposed a project, right? So the company is thinking of buying a machine worth 28,000, right? And there is no value at the end of year 4. That means no residual value. And this indicates the life of the machine is 4 years, right? And 4 years of data are given. So that's the life of the machine. And we are given some expenses, years, the year 1 to 4, and gross profit, right? And some expenses. Okay, so these are the profit figures, these are the expenses. So we have to put the expenses within brackets, okay? And also we have to deduct the depreciation. So now using this, we are going to follow the steps. First, we need to calculate the depreciation, right? Then we are going to fill in our format. Okay. Right. Now, let me just erase this. Right. Okay. Right. So depreciation is the same formula which I showed you earlier, cost minus residual value. So the cost is 28,000, right? You can see that in the previous slide. Okay. The cost was 28,000. Residual value is 0. Useful life is 4 years, right? And the answer is 7,000. So that's your depreciation every year, right? Now we've got the depreciation. So now we are going to fill in our format, right? So this is our format, right? Year, gross profit, expenses, depreciation, and the net profit, right? So we put the values given in the question. Very easy. You just put the values, write year 1, 2, 3, 4. Put the values given in the question, right? These are the values given in the question. And in addition to that, every year you deduct depreciation, 7,000, right? And then you get the final value, which is the net profit. Now, some years the net profit can be negative, right? Which is fine. Don't worry about it, right? It can be negative in certain years. That's okay. Now, once you do that, once you have all the net profit figures, you add them together, right? So you add them together, and that is the total profit, right? I have given the instructions here also. Add the net profit for the 4 years, that's the total profit, divide by the number of years, right? So take the total, 19,600, that's the total of all of these, right? And then you divide it by 4, which is the number of years, and that is called the annual average profit. Once you have that, we can go to the final step, which is the ARR formula, right? So let's do that now. So the annual average profit here is 4,900. Now we are going to put that into our formula. Okay. So the formula is annual average profit, right, divided by the project cost into 100. So 4,900 is our annual average profit. 28,000 is the cost of the machine, if you remember initially, right? It was given in the question, and multiplied by 100. So we get 17.5, right? And we have to put the percentage sign. So we need to have the percentage sign. So we are all done, right? So easy peasy, right? That's the ARR method, right? Okay, so thank you for watching the video, and I'll see you in future videos. Thank you so much.